What if the life insurance policy you had that you thought was for your family after you passed away could also build wealth while you're still alive? I'm here to tell you that many wealthy individuals and families throughout the US utilize life insurance not just for when you pass away, but as a living financial asset for the here and today. I sit down with families all the time. When life insurance comes up as a conversation, it's can be kind of morbid, right? We're talking about if you were to pass away, how much money would you want to leave behind to your spouse? It's a very death oriented conversation. However, that's only a small part to life insurance. On the other end of it, there is the ability to use life insurance to build out a asset class, a financial wealth building tool for you and your family throughout your life, not just for when you pass. And so many of my clients, when we sit down and we build out a properly structured life insurance policy, it's got a few different components to it. It's got cash value, money that can be accessed throughout their lifetime for opportunities, for life's emergencies, for anything that they decide it needs to be used for. Doesn't have to be used just for death. The second component to it is death benefit. If they were to pass away, their family will inherit that death benefit. So let's focus on that cash value piece. So how does the cash value piece to life insurance work? When do we use that? How does that grow? And all of the other questions you may have around cash value inside of a life insurance contract. So when it comes to cash value life insurance, it's important to utilize the holy grail of it, which is whole life insurance. Whole life insurance has been around for over 200 years, and it's been a huge financial tool for some of the most famous and wealthy families throughout the history of our country. Whole life insurance offers you a few different things. One is it offers you guarantees. Every dollar you put into a whole life contract will be worth more in the future. So whenever I sit down with families and we're talking about their financial assets, where they're currently investing their money, I'll ask them, where are you currently putting money that is guaranteed going to be worth more tomorrow? And the only place they usually have some level of guarantees is their savings. So when I share with them that a whole life insurance contract can offer them guaranteed interest growth year after year while they're also protecting their family, they see that as a huge win. Secondly, whole life insurance offers you a dividend. So similar to owning a stock in the stock market, when you own a whole life insurance policy with a mutually owned life insurance company, what that means is that you are a small equity owner in the life insurance company. So let's take a big company that you may have heard of, Northwestern Mutual. Northwestern Mutual is one of the biggest names in life insurance. When you buy a whole life insurance policy from Northwestern Mutual, you are gaining a small amount of equity inside of that company. And so when it comes to the end of the year and your policy just ended year one, and let's say you put $6,000 into that policy and you've got $500,000 of death benefit, and it's time to credit you cash value interest on your policy, they're going to give you two types of crediting. One, they're going to give you the guaranteed interest crediting, which is contractual, no surprises there. Secondly, based off how the company performed that year, they're going to pay you a dividend. And so that dividend can range, and that's not guaranteed, but most mutually owned life insurance companies have paid out dividends year after year after year for decades, even in some cases 50, 100 plus years. So there's a very high likelihood you're going to receive that dividend as well. So going back to it, you start a whole life insurance contract, you've got guaranteed interest crediting, you've got dividend crediting. Well, how about access to capital? In a properly structured whole life insurance contract, you have access to capital throughout your lifetime. What that means is if you need cash for that next car that you need a down payment for, you need cash for getting into a real estate opportunity, for helping fund your children's college education, your whole life insurance policy gives you access to money throughout your life. It's not money that is tied away until the day you retire or 20, 30 years down the road. A properly structured whole life insurance contract can offer you liquidity, access to capital, and oftentimes, if it's structured well, tax favorably is additionally. So you're able to keep Uncle Sam out of the picture. Most people I know aren't the biggest fan of Uncle Sam, so that's another plus. So whole life insurance offers you guaranteed cash value growth. So year over year, your money will be worth more tomorrow. It offers you dividend interest crediting. It offers you access to capital. So when opportunities come their way, you have money ready to distribute. It still offers your family a legacy. If you were to pass away, your death benefit is secured. And it offers you flexibility now, because now we're not just putting money away as a cost and a premium into a life insurance contract, but we're actually building out an asset, right? So when you can take a life insurance policy and you can turn it from an expense into an asset that you can utilize throughout your life and leave a lasting legacy behind to your loved ones, all with the same whole life policy, that's a win for you and for your family. When it comes to whole life insurance, one of the key aspects to these policies that is not well understood by most people, and it's not even understood by most advisors and agents out there, is the importance to overfunding a policy. And I won't get into too many of the details, but the way that a whole life insurance contract goes from being a legacy death benefit focus to being a living financial asset is by having what's called a overfunded whole life insurance policy. The overfunded means that we are putting more money into that policy than is required. And you might say, well, why would I want to put more money into a policy than I need to? And the reason why is because all of the additional money that you're putting into your whole life contract is getting guaranteed interest crediting, it's getting dividend crediting, and it's helping you continue to grow out your cash value at a faster pace, right? So when you think about a traditional life insurance policy, you may think, I want to pay as little as possible. On a properly structured whole life insurance contract, I actually want to overfund it, because every additional dollar that I put into it, past what I'm required to, it helps me build out the cash value quicker. It gives me more access to capital for opportunities. And it helps me still maintain my legacy that I leave behind to my loved ones. So if you're someone right now that understands the value of life insurance for the death benefit side of it, but you don't want to have any more expenses and you want to be able to utilize life insurance as an asset and a tool for your financial future as well, then whole life insurance may be the best option for you. And I'd be happy to share more with you. Whole life insurance has been around for over 200 years, as I mentioned, and it's an incredible tool that is oftentimes misunderstood. And I'm going to share much more content on this on future episodes, and I look forward to connecting more with you guys. If you found today's content interesting or helpful, leave a like, comment in the section below, subscribe for more content like this, and I look forward to hearing from you guys.